Welcome back to Squawk on the Street. Just about a round trip for stocks since that so-called Liberation Day tariff announcement. After a big rebound driven largely by tech this week, Jefferies chief market strategist David Zervos is here with more on the road ahead and to help us understand this past week. David, thanks for joining us. Good to see you.
Good to see you, Carl.
What do you think accounts for this rebound?
So I think a lot of it had to do with the confusion in the second week of April. That second week of April, the correlation patterns, Carl, they just went wacky. We saw one of the largest moves higher in long-term interest rates since the early 1980s. We saw dollar weakness and we saw equity weakness. A correlation pattern that I think many said was associated only with emerging markets. People were talking about the return of the 70s and stagflation and losses of credibility. And I think it was a flow-driven story. I think adversaries in the trade war that have large piles of U.S. securities used some of those to try to dislodge the post-trade battle announcements in April 2nd. And we sort of recovered largely on the back of statements by the Secretary of the Treasury that they could stop that through buybacks and other mechanisms. So I think we found some ground and dealt with that issue, and that issue is now off the table. And I think the market is looking forward at all the things that are much more positive about a leveling of the trade imbalances, a leveling of the fiscal imbalances, a deregulation story that's still in the background, and a lot of positives that really were the topics of our discussions for the first month or two of this year.
Do you believe the Japanese finance minister when he says, and I want to get the quote right, we obviously need to put all the cards on the table in negotiations. It could be among such cards, referring to their Treasury stockpile?
I did see that. I thought it was a very strong statement. And I think it's true. It's true that in this negotiation, everything is in play. But the U.S. still holds the cards here, Carl. They really do. This is not something that is going to dislodge the trade negotiations. If there is nefarious foreign selling of duration in the U.S. fixed income markets, the Treasury and the Fed, either one, on their own or together, can stop that and turn that purely into a currency trade through either an issuance change or a QE change. And that is important because the currency change is actually going to help the U.S. rebalance because they're going to be weakening the dollar, which brings us back to a more competitive place. It's the duration when they sell it that dislodges our capital markets that gets in the way of these trade negotiations.
There's also this idea that there's really nowhere else to go, right, David? That's always been the case for the dollar, for the Treasury market, and I think increasingly for U.S. growth. A few weeks ago, we were sitting here on the desk talking about the Sell America trade because of the tariffs. Now, with the Mag 7 earnings coming in pretty much strong, as Dan Ives was just saying, AI theme very intact, with the de-escalation in trade and with the better economic numbers even coming out of some of those trade announcements. Is it Buy America again? Is that what this is all about?
I mean, I don't think Buy America ever stopped, Sarah. I think there are people that will move to the euro. The euro is the natural place. It's the biggest place you can go to an alternative to the dollar. And it has been an incredible run. In the last 2 months, the euro is up 10% relative to the dollar, 5% in the last month, even with the stock market and bond market largely unchanged. This has been a major, major currency trade, Sarah, something I know you watch very carefully. In fact, last night we saw the Taiwan dollar move 4% stronger.
That's a trade. If even with all the excitement about Germany spending this year, the U.S. is the only one of the big economies in the IMF that's supposed to grow almost 2%. I mean, even with all German spending, I think it's barely going to grow this year.
You're not going to get me to get excited about buying European stocks. That's not happening here or at any time soon. But I do think the euro is going higher. And I think the dollar is going weaker. And I think the story is really a 1985-style Plaza Accord story, where in trade negotiations, we are going to rebalance the playing field. And part of that is ending what this administration sees as currency manipulation. The dollar is still very strong. It's within the last 20 years, the euro's traded at 160. Dollar yen's traded at 75. The pound is traded over 2 to the dollar. This is an extraordinarily strong dollar, and it makes us less competitive. It is the standard competitive devaluation story that we've seen over and over again in many, many circumstances. And I think I call it, in the U.S.'s case, a competitive revaluation, because we're not devaluing. It's still a strong dollar world, still a reserve currency dollar world. I think part of what the Commerce Secretary, the Treasury Secretary, the Trade Representative are all going to put on the table is a program by which countries have to think about not just changing what they buy from the U.S., not just getting their trade imbalances set through purchases or through tariff changes, but also through currency policy. And maybe what we saw in Taiwan last night was the beginning of a move toward a more plaza-like dollar rebalancing trade, which should be really helpful in bringing our trade deficits down and rebalancing what this administration sees as an unfair trading playing field.
Right. Yeah, sounding like Myron, who's also on the tape today. And these, we'll see if we get these accords, these Mar-a-Lago accords. David, good to see you as always. David Zervos.